Hey, this is Justin with DayTradeTheMarkets.com, and I wanted to speak about an issue that, as traders, we all face to some degree or another, and that's exit strategy and struggling with when exactly to get out of a trade. The reason I wanted to do this video now is because I was recently speaking with a client who happens to be a relatively new trader, but honestly, that doesn't really matter. I mean, even experienced traders, I think, deal with this issue certainly from time to time. But what he was saying was that he was struggling because he was getting out of profitable trades a little bit too early. And in other words, he was getting into a trade, it would go 2 or 3 or 4 ticks in his favor, and he would just want to bail on the trade in fear of giving back that profit. And I think that's a very common thing that, like I said, I think most of us have probably faced at some point or another. And if not, you may have faced the other issue that's probably not as common, but certainly does happen. And this is something I've struggled with myself as well. It's holding on to trades too long, trying for that big winner, and then staying in too long and giving up too much profit. And so, what I wanted to do in this brief presentation, just go over some of the basics about this idea, hit on some of the hidden reasons behind this relatively common challenge or struggle that a lot of traders face, and then offer a few solutions that I think you could put into your trading and kind of give you a new concept perhaps that you could put into your trading if you happen to be facing this issue. So first, let's go over some kind of obvious basics, but I think it's important to kind of set a foundation. But obviously, after you enter a trade, at some point you have to get out, and you're either going to get out with a profit if it goes your way, or you're going to get out with a loss if it goes against you. That's quite obvious. That's pretty simple. But here's the key. The goal is that you want to find a way to minimize your loss on losing trades. You will have losing trades, so you want to minimize loss on those losing trades. You also want to then maximize your gain on winning trade. That's on winning trades. Again, these are very basics. It's a common thought, sometimes easier said than done. Okay, so again, simple concept, but the ramifications are very big of minimizing loss on losing trades, maximizing gain on winning trades, because I want you to just stop for a second and try to consider how these little things add up. Just think about over the past month or the past 12 months or whatever time frame you want, and do a really conservative exercise. What if you could have increased your profit on winning trades by just 1 tick per trade, or even a half tick on average per trade? Or what if you could have decreased your losing trade by even a half tick on average per trade, per contract over the course of the last 12 months? It's a very little incremental difference, but that adds up to huge results. I think you could do the math if you want, but I think you probably get the concept as well. Small things add up to big differences over time. Okay, so again, great in theory, but the challenge here with exiting, and the thing that we have to overcome, is that emotion often comes into play when we're in a trade. And you've probably heard the idea of fear and greed. And I want to hit on a little bit deeper level in just a second, but obviously, when you're exiting too early, that's when fear is coming into play. You're afraid to lose the profits that you have right now. Kind of the idea of the bird in the hand idea. You have a profit now and you're afraid to lose that. Makes sense, but that's fear. Greed, on the other hand, is getting out too late. You're again afraid to miss out on a potentially big move. In other words, you would find it painful to get out of a trade now, even if you had a profit, in fear that this thing's going to take off and you're not going to be on board the train. So fear and greed, obviously, it's what make the markets what make the market make their it's what makes for opportunity in the market, but it's something that if you are not able to get a handle on, can certainly hurt you, and can certainly hurt you in your exit strategy. So want to identify and then go over a couple of solutions. First and foremost, you need a shift in thinking. I'll talk about that in a second. You also then need a shift in strategy. If you're just going to have one of the two, you want a shift in thinking, but ideally you need both if you want to make some strong gains in being able to, again, maximize profit on winning trades, minimize the loss you have on your losing trades. So first, let's hit on this idea of a shift in thinking. And again, this is kind of the hidden reason behind that fear and greed idea, and it's something we talk a lot about, and that's process thinking versus results thinking. And another way to put that is, when you're in a trade, and this applies to, we talk about this a lot in terms of when you get into a trade, what's the reason behind getting into a trade. The same would apply in getting out of a trade. So is your focus on making the best decision at a given moment? That's process thinking. Or are you focused on the money? Are you focused on what the result is? So process versus results thinking. And so again, if you are worried about losing the profits you have in hand right now and you get out of a trade too early, that's results focused. Okay? You're focused on the money. You're focused on losing out on the money. If you have some reason to get out of the trade but you stay in too long hoping not to miss out on the home run or the big trade, what are you thinking? You're thinking about your results. You're thinking about the money. So that's the first shift in thinking that has to occur. And this, again, is such a huge thing. It's a subtle shift, but it's a very huge shift in both entry and exit thinking, but focusing on process thinking, focusing on making the best possible decision based on the evidence that you're seeing. So again, obviously that shift in thinking is incredibly important, and that has to come first. Without that, you are at the mercy of your emotions. And by the way, the idea of becoming emotionless, like you hear some people saying you want to take your emotions out of trading. To me, that's just total garbage. I mean, you're a human. We are emotional beings. We're not robots. And so many people try to make their trading robotic. And to me, I mean, that's just crazy. We are emotional. We want to not put the clamps on our emotions or to shut our emotions down. You want to be able to control your emotions, work with your emotions. Okay, so that a little bit of a side note. Sorry about that. But again, once you make that shift in thinking, the next step is to make a shift in strategy. You need to have an exit plan, and I wanted to introduce a few strategies here and talk about a few ideas that you can use to overcome these ideas. So first and foremost, what is your exit plan? What do you do to protect yourself? I want to talk a little bit also about what to do if you think your stops are a little bit too tight, and then I also want to talk about what to do or an idea that you can use to maximize profits on winning trades. So let's move into the idea of some strategies at this point. And to me, there are several strategies. This is the tip of the iceberg, but one strategy, and what I think to be a very good starting point, is having a systematic exit plan. And by that I mean you have you get in, you have your stop in place, and you have the idea of you either have a target locked in place that you program into your software, or you scale out to some degree. There are a million different systematic exit plans. And again, this is not my favorite way to trade in terms of having a systematic exit plan, but it's certainly a good starting point in that it's going beyond being at the whim of your emotions. So in other words, you have a plan and you stick to that plan. That's a great starting point. Now, I think with time and experience, I prefer, and I'd like to invite you to consider shifting to what we call more of an evidence-based exit plan. And again, first, a systematic exit plan, good starting point. You're going beyond fear and greed. It's having some kind of predefined exit strategy. It could be a predefined target, could be a scale-out plan. The key, again, is having a plan and then sticking to that plan. Okay? Now, taking it to the next level, and again, this is what I would call next level thinking. This is by no means genius level, or I'm not saying I have all the answers, but this is kind of the next level of thinking about exits, is having more of an evidence-based exit plan. And this can be certainly applied to both exiting for a loss, minimizing loss, or exiting for a profit and maximizing profit. And it starts with the idea of why did you get into the trade? Okay, what were the reasons behind getting into the trade? And first and foremost, and we talk a lot about this obviously when we talk about getting into trades, but again, why did you get into the trade? If you don't have a good reason for getting into the trade, first you should probably get out right away. It probably means you're focused on results. You're focused on the money. You're probably trying to get some money back, or you're trying to get rid of some losses, or you're getting greedy and trying to have a huge day. But if you don't have a good reason for why, an evidence-based reason for getting into the trade, get out. But assuming you did have a good reason for getting into the trade, you had some evidence for taking the trade that you did, you want to ask yourself that question. and then you wouldn't want to get out until there was a reason that that evidence is no longer valid. In other words, until contradictory evidence appears, and no sooner. So again, if you get into a trade for a good reason, it stands to reason that you would want to stay in that trade as long as that logic still applies, as long as that evidence still exists. So stay into the trade until you get evidence, actual evidence from the market that something has changed. If nothing changes, you will want to stay in the trade. Okay, so that's an evidence-based plan. It's staying in flow with the market. It's not getting overcome by your fear or your greed. It's not getting overcome by being too systematic. You're waiting on evidence to get out of the market and then no sooner. And now in taking that evidence-based exit plan, so taking that to the next level, I want to talk about 3 different concepts that you might use. I'll specifically talk about using it with the DayTradeTheMarkets software, but even if you don't use the DayTradeTheMarkets software, these type of ideas can certainly apply. So even if you don't use the DayTradeTheMarkets software, hopefully you can apply these same ideas in some way. But 3 ideas I want to talk about were a target-based idea, the idea of trailing using aggression bars, and then the idea of waiting for contrary aggression evidence. And so I wanted to show a few examples and show some of these ideas, and I've kind of stripped our charts down. There's a lot more evidence that you can see on the chart, and I'm not going to get into a great amount of detail in this video about what all of this is. I just want to kind of show the concepts regarding exit strategy, and there certainly are a lot of videos on the website that you can check out to get more information about this, or send me an email at info@daytradethemarkets.com and I can explain some of these theories in a lot more depth by all means. But let's just, for the sake of this illustration or these examples, let's assume we got long here, right in this area, in this green support zone, which also happens to be the base of what we call a level 3 or extreme buying aggression bar, which we know to act as pretty good support. So again, just for the sake of this, let's just assume we got long right in this area. Okay, and let's talk about some different exit strategies. First and foremost would be a target. Okay, so if you have a reasonable target, whether that's a bigger picture level, whether that's in this case a resistance area, potential resistance area like this, there is some evidence. Again, it's not just getting out of the market based on a hunch. You actually have a reason. So getting in right in here, certainly you can make the case for getting out when the market reaches this next target, especially if we talk a lot about putting the market in context, but especially if you have made the analysis based on other evidence that we use that the market's more in a consolidation or not likely to break out, then certainly having a predefined target makes some sense, and using something like this red resistance zone would be a good place. So in other words, you got in here, you had a plan to exit when the market got to this red resistance area. That would be a target-based way to go. Okay. Now another idea would be to use what we call the aggression bar trail. And again, these aggression bars, we have several levels. Here's what we call a level 2 bar. Here's what we call a level 3 bar, and you can change the colors on these. But level 2 means strong buying aggressions coming into the market. Within that bar, what the order flow is telling us is that buyers are really taking over. And these are considered strong bars. These are considered extreme bars. Okay, and so again, more detail on the website, or I could fill you in on that. But the idea here would be, again, assume that you got long in here. You're not going to go for a target. You're going to trail using aggression bars. So you're going to stay in the market until either you get stopped out below this, or until you see more buying aggression bars come in, and when they do, you're going to use them to trail your stop. So again, we flutter around in here back and forth, but again, there's no evidence at this point. We've seen no selling aggression like we see up here, which I'll talk about in a second. We've seen no selling aggression come into the market, so you're going to sit tight. The reason you got in, which was in here, is still valid. Nothing's changed in this area right here. Then we get a buying aggression bar that comes in. So at that point, you want to start using these to trail, because if this buying aggression bar got taken out by 2 ticks or so, that would tell you some contrary evidence is coming in, because when buying aggression comes in, the market should continue higher. That's the theory, at least. So again, this bar comes in, you want to place your stop a couple ticks below it. Here's another one. Let's place our stop a couple ticks below it. Here's another buying bar. Let's place our stop a couple ticks below it. Here's another one. Move the stop, trail the stop up a couple ticks below. Here's another one. Let's trail it up a couple ticks. Here's another one. Let's trail it up a couple ticks, and we get stopped out right there. So again, it's going for a little bit bigger move, but you're not just holding on forever, and you're not getting out too early. You're waiting until the market gives you evidence that suggests it would make sense to get out. In this case, again, we're not using the target, you're using the aggression bar trailing method. So when an aggression bar comes in the direction of your trade, you simply trail your stop up. When that aggression bar, so a reason, evidence, a reason to get out, not staying too long, not staying too short, have a reason, using these paint bars that trail. So when a buying aggression bar finally gets taken out by a couple ticks, and depending on the market, you can change the number of ticks, but this is the E-mini, gets taken out by a couple ticks. Well, that's the first evidence that the pure wave of buying is over. There's evidence to get out. It makes sense. Okay. Another method, which is a little bit more in depth, would be the contrary aggression. This takes a little bit more stomach to do, because you can give away some profits, but you can also capture some really big moves. But again, let's just assume we get in right here. Again, we're going to stay in until either we get stopped out below our entry, or until we see that the other side, in this case selling, has come in. Okay, so in other words, we're gonna hang out. We're not gonna get out of the trade for any other reason but the other side coming in. And you can see in this case here, back and forth for a while. That takes a little guts to stay in there. But again, no reason has come in at this point to suggest that selling is coming into the market. So we're still in the market. We continue higher. Again, we're seeing some buying but no selling, so we just sit tight. We sit tight. It's not until this point here where we have what we call level 3 selling aggression bar. That's showing us that some extreme selling is starting to come into the market in real time. And when that happens, again, you don't necessarily just want to exit at right then, but you might want to place a stop, move your stop up a couple ticks below that, because that would show that when selling is coming in and it's actually having a little bit of follow through, that's telling us that's for the first time. Now this happens in this case to pretty much agree with the aggression bar, but they don't always correlate perfectly like that. But again, you're waiting until you actually see the other side. In other words, contrary evidence, not just a trail, but contrary evidence that the other side, in this case we're long, so we're waiting until we see some strong selling, but it's actual evidence-based strategy. It's not just, well, I think I've made enough profit here. Okay, you're waiting on a reason to get out of the trade. Hopefully that makes some sense. Same thing can apply on a situation where you, again, well, let me rephrase. Sorry about the words there. The first 3 examples I've talked about were trying to maximize profit on winning trades. We also want to protect ourselves. Basic risk management, we want to protect ourselves and be smart with a protective stop. But a common mistake, and this is something that I've certainly battled with, and I think a lot of people battle with, a common mistake, and we think we're protecting ourselves, is that we use too tight of a stop. And we think we're using good risk management. We've been told to use a tight stop, and that's important, but sometimes that can lead to getting knocked out of a trade before we're actually wrong. Okay, and so I'm sure you've experienced this, where your stop gets hit and then the market goes and continues in the direction of your trade, but you're out of it. And so that's obviously very painful. And again, taking the evolution of your thought process away from just a rote idea of a money management stop toward more of a structural stop or an evidence-based stop. So in other words, again, let's say that we, instead of getting in here, let's say we waited for some buying evidence off of this green, and we waited to get in when we started to see some buying come in. We got in there, maybe we got in at the high of this bar when it got taken out right here. Okay, so if you're using a really tight stop of point and a half, then your stop's going to be somewhere in here or in here. But in essence, if the market comes and tests this green zone again without any selling coming in, there's no reason we're wrong. The reason we got in is still valid. Okay, so ideally we'd want our stop to be a little bit lower. Well, maybe that's 8 or 9 ticks, and that's more risk than you'd prefer to take on a trade. So I wanted to kind of talk about an idea that you might consider And that would be to put your stop a little bit wider than you might be comfortable with money-wise. Okay? Now this takes a little discipline, but that way you don't get knocked out before you're, quote, wrong. And you know, there's nothing wrong with being wrong on a trade. You're not always going to be right, but you don't want to get knocked out before you know you're wrong. The key in risk management, in my opinion, is to know the point at which you would be wrong on a trade and not and protect yourself, and then try to enter in a low risk way, so that if you're right, you get paid for that, you get rewarded, and if you're wrong, your risk is minimal. So in this case, let's just assume that your stop needs to be down here. That's a little bit wider than you'd like to take on an average trade. Okay, this doesn't necessarily have to apply to you in terms of how you trade exactly, but at some point you'll need a structural stop that's a little bit wider than what you might be comfortable with. So I would recommend putting your stop there that's a little bit out of your comfort zone, and 5% of the time that's going to get hit. Okay, but what you're doing is you're protecting yourself against some crazy market event, some crazy news, or some flash crash, whatever. You don't want to trade without a stop, because you can really, 1 out of 100 times you can get hurt. So you want to protect yourself for that worst case, but you also don't want to put your stop so tight that you get knocked out again before you're wrong. So in this case, put your stop down here if you entered in here. And if you do start to see some selling come into the market with, say, a selling aggression bar, let's say you saw some selling come in right here, well, you can bail. You can get out for a point loss or a 5-tick loss or a 6-tick loss. 95 out of 100 times, you're going to see some selling evidence come in here before your stop is hit. If that happens, you just get out. You still have your, in essence, your tight stop, your tight risk management, but you're getting out. You're minimizing your loss on a losing trade based on evidence. You're not just getting stopped out because you thought you were protecting yourself by having a really tight stop. It's a little bit, I don't know if I did a good job explaining that, and it's a little bit of a subtle concept, but I hope you understand what I'm saying. Again, if you place your stops too tight, you might think you're protecting yourself, but you can get knocked out before you're actually wrong. Whereas if you put your stop a little bit wider, but then you're willing to get out and have the discipline to get out early, but only when you see the other side coming in, you still have that tight risk management, but you don't risk knocking yourself out too prematurely. Hopefully that makes sense. But again, the idea here, minimize loss on losing trades, maximize profit on winning trades. So, in conclusion, this video is a little bit longer than I expected it to be, but in conclusion, the first key is to be process focused. Again, focus on proper decisions as opposed to focusing on the money. That and that alone, if you take nothing else from this video but this concept, that can be the turning point in anyone's trading career. That is, to me, that is everything. When you're focused on decision making versus results, that's when you turn the corner as a trader, or that's when you take your trading to the next level. The next key is strategy, having an exit strategy, and certainly in our opinion, having an evidence-based exit strategy is kind of taking it to the next level. That's the ideal. And so, again, this is just the tip of the iceberg in terms of what the Day Trade the Market software can do. It's giving you a ton of evidence that you can use to help you make better decisions. And there's a lot of other videos on the site. If you want other information about this, you can email us, check out the website. But again, whether you use our software or you're interested in not, hopefully these concepts have been helpful, and you can use these to some degree. And again, if you got nothing out of this other than this concept right here, I hope that this 20 minutes has been worth your time. So let us know any questions you might have, and we'll talk to you soon. Thanks.